So for this chapter, basically, we are going to, whoops, wrong chapter there, chapter 5. We're going to start talking about the income statement as it relates to companies that sell merchandise, such as Target, or companies that manufacture goods. But we're going to start with like a merchandising company. A merchandising company is a company that purchases inventory for resale, okay? Can anyone think of a merchandising company apart from Target?
Bait shop.
I'm sorry, bait shop? What else? You meant, what?
Amazon.
Amazon. I love Amazon. What else? Office Depot, Walmart, REI, you name them. They all purchase items for resale. So that's what we're going to talk about in this chapter. And quite honestly, it's really the concepts we've gained. We're not learning anything new. What we're understanding is when we're dealing with merchandising companies, what gets put into inventory. Okay, that's really the change that we're going to talk about here. But basically, when we're dealing with these companies, the wholesaler sells the goods to the merchandiser, who in turn sells them to the customer. Best Buy is another one. Now, the way it works when we're dealing with merchandising companies, they receive revenue. But that sales revenue, when I go and buy a 40-inch TV, I want a 72-inch TV now. It's not going to happen. But you know, they used to be so expensive. Now they're pretty reasonable. I don't want to watch my hockey game. I want to watch good movies. But I remember the first 35-inch TV we bought was probably $3,500. Now you can get a 35-inch TV for $200. Do you know what I'm talking about? They're just getting so cheap. But when I go and spend $400 on a TV, it's really not accurate to show that their revenues are $400 because they have inventory to offset that with. Do you guys know what I'm talking about? So this type of income statement we're going to look at shows how we are going to take into account and show the income or the sales revenue less the cost of goods sold equals something new called gross profit. Now, when we're dealing with a service business like a Jiffy Lube, I mean, I guess they do have cost of goods, the oil, but for the most part, they're providing you with a service. Or a salon, or can you think of some services?
Cleaning company.
A what company?
A cleaning company.
Cleaning company. There's not a cost of goods sold in there. There's really the sales revenue and then your expenses. But when we're dealing with merchandising, we're going to see something new called a gross profit. Gross profit is basically your revenue minus your cost of goods sold, give you your gross profit. Then we've got all these operating expenses we're going to talk about to come up with a net income. And it says here, cost of goods sold is the cost of merchandise that gets sold during the period. Does that make sense? Now, there are various operating cycles of a business. In a service company, you perform a service, you bill, you get your money, you perform the service again, you bill, you get your money, you perform, it goes on and on. With a merchandising company, there's another step in here. You have to get cash to buy inventory. Then through the inventory, you put it on sale, you sell the inventory to then get your money, receive the cash to purchase more inventory to put it on sale. So there's an added step in here, inventory, the purchase of inventory. So this chapter is really just focusing on a specific type of company and the unique financial statements involved with this type of company, okay? So these operating cycles basically just show the process that it occurs over and over again in a company. You need money to buy goods, to sell goods, to then collect the money to buy it again and start all over again. Now, there are various flow of costs. And when we're dealing with inventory, we start with a beginning inventory, then we purchase various goods to add to that beginning inventory, which then make it what's called something called cost of goods available for sale. And then from that, we sell goods, and that piece is the cost of goods sold to give us our ending inventory. So we'll determine our inventory at any one time by starting with a beginning inventory balance, adding to it what we bought during the period, subtracting to it what we sold to come up with our ending inventory. Make sense? Now, there are two types of inventory systems. In this day and age, most people do have a perpetual inventory system that at any time they can always track how many goods are on hand. How many of you know how well that works or doesn't work? I know that happens. I go to Macy's and say, oh, I'm looking for this dress in this size. Oh, we have 3 here. It's like, good luck finding them. Or I go to Menards. We were having bookcases, and it's like, oh, there are 4 more out there. Well, there weren't to be found, but somehow, I mean, they're doing the best they can with this perpetual inventory system, but it doesn't always work. That's why it's important to do a physical count at the end of a period. Does that make sense? How many of you guys work in a place where they still require a physical year-end count? Because you can't always trust it. Also, things walk away, don't they? So, flow of costs. We start the year with so much, or the period with so much inventory. We purchase to it, we sell it, we have an ending inventory. The perpetual system means that there's detailed records of the inventory, and you always can tell what is on hand at any given time and what is sold at any given time. Perpetual systems are more common nowadays just because of the computer system, okay? Now, it's easier to have a perpetual system with few high volume items, isn't it? When you're dealing with 10,000 screws, it's a little harder to have that kind of system in place because of the pure volume. But in this day and age, the software allows for that. Under a periodic system, which means you count at the end of the period, with the periodic system, you don't keep some real detailed records all the time. The cost of goods sold gets determined by the count at the end of the period. And the way it gets determined then is you start the year with certain inventory, you add the purchases, then you count the ending inventory to know what was sold. Make sense? What's the advantage of the perpetual system? High unit values are common with that. Shows the quantity and cost of the inventory that should, do you hear that word, should be on hand at any given time? And it should provide better control over inventories than the periodic system. Now, how do we record merchandise? Depending if it's cash or on credit, we're going to record it when the goods are received from the seller. What happens when the goods are received from the seller, then we should receive a purchase invoice that would support the goods that were received from the seller. Here's an example. Salk Stereo, who's the buyer, uses as a purchase invoice the sales invoice prepared by PW Auto Supply, the seller. We're supposed to prepare the journal entry for Salk for the invoice from PW Auto as of May 4th. So May 4th, you can see, is the date. We're showing inventory on hand of $3,800, which you can see that's the total here. And since it's on credit, we haven't paid cash for it, we're going to debit our inventory, which is an asset, and we're going to credit our accounts payable, which is a what? Liability. We're going to owe that money. Now, that's just the product. There are other things that will get added to inventory, okay? One thing is called freight, gets added to inventory. There's different ways in determining who pays the freight and when ownership passes from seller to buyer. Here, FOB shipping point means free on board to the shipping point. The shipping point a lot of times can mean the warehouse of the seller, or if UPS takes it to that UPS point. So ownership passes. You see how the seller is taking it to UPS, let's just say, and handing it off. Well, then UPS is going to go and deliver it to the buyer. It's free on board to the shipping point, which means once it goes to UPS, the title to the goods passes from the seller to the buyer. Does that make sense? Do you guys know what I'm talking about? How when you do purchase things, sometimes it's very clear who's responsible for the goods in transit? Ownership of the goods passes to the buyer when the public carrier accepts the goods from the seller. Now there's something else called FOB destination. This is free on board until it gets to the buyer. So even the public carrier who's delivering it, it's still in the hands of the seller until the buyer takes it here. Ownership of the goods remains with the seller until the goods reach the buyer. Now, when the seller sells the goods, those selling expenses are considered an operating expense. But if we have to pay for freight costs to purchase goods, we're going to add that to our cost of the goods. We'll talk about that in just a minute. Assume upon delivery of the goods on May 6th, SOC Stereo pays Public Freight Company $150 for freight charges. The entry on SOC Stereo's books is inventory of $150. You see how it's getting added to our inventory? And cash of $150. Assume the freight terms on the invoice had required PW Auto Supply to pay the freight charges. The entry by PW Audio Supply would have been freight out $150 and cash of $150. So basically what we're seeing is if SOC has to pay for the freight, we're putting it in our inventory. Okay? That's the key here. Now, in a perfect world, everyone buys goods and they keep them forever, but it doesn't always work that way. Have you guys ever purchased something you returned? So when you return it, what happens? The company needs to record those purchase returns. And it's actually smart for them to keep track of what has been returned to see maybe there's an issue with a certain product. Okay? So sometimes they don't, they just lump it back into inventory, but they're smart to show purchase returns so they can keep track of why, or if there's reasons why certain items are continually being returned. A purchase return goods for credit if the sale was made on credit, or for a cash refund if the purchase was for cash. There could be what's called a purchase allowance. They keep the merchandise if there's a reduction in the price. Usually that might happen because you ordered red widgets and you got blue widgets. And you didn't want the red widgets, but you could kind of use them. But the the seller's going to give you a deal, so you'll keep them because they can kind of work for you. Get what I'm saying? So you can have a purchase allowance or a purchase return. Here's an example. Assume SOC Stereo returned goods costing $300 to PW Auto Supply on May 8th. So they're going to, SOC Stereo is going to reduce their accounts payable because they don't owe all that money anymore. Since they returned some goods, think about it, they owe less. Make sense? They owe less, so they're returning $300 and they're reducing their inventory by the same amount. In a perpetual inventory system, a return of defective merchandise by a purchaser is recorded by crediting A, purchases, B, purchase returns, C, purchase allowances, or D, inventory. Crediting inventory, because you're reducing your inventory, okay? Now, sometimes there are situations where a seller tries to encourage you to pay the money quicker by offering credit terms or discounts. Credit terms permit buyers to claim a cash discount for prompt payment. Why? Purchaser gets to save money and the seller gets to get the cash faster. So an example of this may be 210 net 30, meaning you get a 2% discount if you pay within 10 days. Otherwise, you need to pay the whole amount within 30 days. Okay? Have you guys seen that ever before?
I have. Is it still pretty popular?
Yes.
Okay.
With large companies, it is. So here are examples. 210, a 2% discount if paid within 10 days. Otherwise, the whole amount's due within 30. Here's another one, 110 EOM. 1% discount if paid within the first 10 days of the next month. Or net 10 EOM. Net amount due within the first 10 days of the next month. Again, don't worry about the EOM. You know, most of what we're going to do is this like 210 net 30. Okay, I'm not trying to trick you. Assume Salk Stereo pays the balance due of $3,500, gross invoice price of $3,800, less the purchase returns and allowances of $300. Remember how we returned $300? On May 14th, the last day of the discount period. Prepare the journal entry Salk makes on May 14th to record the payment. So we're going to show an accounts payable of $3,500. Think about it. It started with $3,800. We returned $300 of it. So we need to get that difference off our books. Now, even though we're not going to pay that whole $3,500, we need to get it off our books because we're not going to owe it. We're going to reduce our inventory by $70 because we've got a balance due of $3,500, but we get a benefit of 2% if we pay it quickly. So it'll reduce it $70, which means we've got to come up with cash of $3,430. Does that make sense? So think about this. We didn't show cash $3,430, accounts payable $3,430. We want to get the accounts payable off our books. Okay? So we need to show that entire amount. But since we're really paying $70 less for those goods, we're going to reduce our inventory by $70. Make sense? Because we don't have to pay the $70 more. Okay? So accounts payable $3,500, we'll credit our inventory, reduce our cash. If Salk Stereo failed to take the discount and instead paid the whole $3,500, we would just show accounts payable $3,500, cash $3,500. Make sense? Now, how do discounts work? Why should we take them? When shouldn't we take them? What we've got to look at is a discount of 2% on $3,500. What could we do with that $3,500 for 20 days? Investing $3,500 at 10%, remember that 10% is over 12 months, for 20 days, saves, we would earn $19. But 2% on $3,500 is $70. Do you see how it's beneficial for us to take that discount? Because we can't make that money any better. Okay? If we saved our $3,500 in a bank, we'd make $19. But if we use the 2% discount, we would save $70. So the difference in doing one versus the other, you know, we're better off $70. The net difference is $50. So do you understand how you can compute if it's wise to take the discount or not? Make sense? 2% for 20 days basically provides you with a 36.5% annual interest rate. You're not going to beat that, especially in this day and age. So far we've got the $3,800 we initially bought. We have freight that came in. Remember, we had to pay for our freight. We returned some goods, and then we get this $70 discount when we paid for it. So we have a new balance in our inventory account of $3,580. All of this is related to buying those goods. But the point here is to help you see a lot goes into inventory. Our freight goes into it. If we have any discounts, we're going to show it, reduce it. And if we have any returns, we're going to reduce it too. Now, recording sales made using cash or credit. Sales revenue, like service revenue, is recorded when the performance obligation is satisfied. The performance obligation is satisfied when the goods are transferred from the seller to the buyer. So basically, usually the seller has to ship the goods. Technically, you shouldn't be recording a sale of goods unless the goods have shipped, excuse me, from the seller to the buyer or left the warehouse, okay? Journal entry to show a sale. So let's just talk about we are selling the goods. We're going to either debit or increase our cash or receivables, and then we'll credit our sales revenue. Okay? But we also have to do another journal entry too. That's one half of the equation. We then need to take those goods out of inventory and show we sold them. Okay? You see how it's just not performing a service? We're getting rid of inventory, so we have to report it. PW Audio Supply records the sale of $3,800 on May 4th to Sock Stereo on account. As follows: assume the merchandise cost PW Audio Supply $2,400. So they sold the goods of $3,800, but it cost them $2,400. So the first thing they need to do is show accounts receivable of $3,800 in sales revenue, but they also have to take that inventory of $2,400, take it out of inventory, and show it's a cost of sales or cost of goods sold. That makes sense, guys? So on one half, we're showing the sales price of the goods, but then they have to take the cost of that inventory and get rid of it and show that it's sold now. Okay? So, sales returns and allowances. The flip side of purchase returns and allowances. So let's just say someone returned a sale item. Prepare the entry PW Audio Supply would make to record the credit for returned goods that had a $300 selling price and a $140 cost. They weren't defective. We're just going to assume they were still in working order. We want to show sales returns and allowances. We're going to reduce our accounts receivable because they don't owe us $300. They owe us $300 less than what they did because they returned goods to us. Then we also have to show that our inventory increased and our cost of goods sold decreased. Are you guys following me? Is it making sense? Assume the returned goods were defective. They weren't just being returned, they were not, we couldn't sell them again, and had a scrap value of $50. PW Audio would make the following entries: sales, returns, and allowances of $300 and accounts receivable, just like we did earlier. But now we're going to show inventory of $50, not the $150 or $120, and cost of goods of $50. Because they're not the par, they weren't the standard that we once had. Since we can't resell them at that cost we had, we've got to show the new value, lower of cost or market. But since they're not worth that cost anymore, we've got to show the new value back into our inventory. The cost of goods sold is determined and recorded each time a sale occurs in A, periodic inventory system, A, perpetual inventory, both or neither. The answer is the perpetual inventory system method. we'll always know what that actual cost of that inventory is in a perpetual, right? How are you guys doing? Let's do a problem real quick, okay? Let's go to page 2. No. Okay, 262. Okay. On April 1st, okay, prepare the journal entries to record the transactions listed above on Crisp Company's books. Crisp Company uses a perpetual inventory system. So let me just okay. So let me make this bigger so you guys can see it. How do I get this thing out of here? Huh. I don't know. Seems like there's a way I should be able to remove that, but okay. Let's go back here and did I screw up? I did. I deleted something, didn't I?
I think you X'd out of the window.
Darn it. I don't even realize I do that stuff. Okay, I'm sorry. Does anyone remember the page 262?
Yeah.
I think I do that a lot and I don't even realize I do it. Okay. On April 5th, purchased merchandise from Frost Company for $28,000, terms 210 net 30. So we don't know. We might say that we for sure want to use the discount, but we're not going to even deal with the discount till we pay the bill. So right now, we need to record the journal entry that shows we purchased merchandise of $28,000. We're going to show that by debiting inventory of $28,000, and we're going to credit our cash of $28,000. Excuse me, not cash, accounts payable. So inventory gets increased, our accounts payable gets increased, okay? Next, does that make sense, guys? Next, on April 6th, we paid freight costs of $700 on merchandise purchased from Frost. What account do you think we're going to put that $700 in? Does it get added to inventory? Yes, it gets added to inventory. So we're going to show inventory, $700, Cash is a decrease of $700. Next, on April 7th, we purchased equipment on account, which means a payable, for $30,000. So here, we didn't purchase merchandise, we purchased equipment. They're trying to trick you up here, okay? Merchandise is inventory. Equipment is an asset. So here we're showing equipment of $30,000, accounts payable of $30,000. On April 8th, we returned $3,600 of the April 5th merchandise to Frost Company. What are we going to do, guys? We're returning some inventory.
Just decrease inventory.
Decrease inventory and
Decrease.
decrease accounts payable. So we will show accounts payable gets decreased to $3,600. Inventory gets decreased to $3,600. Make sense? Next, on April 15th, paid the amount due to Frost Company in full. Okay, so guys, we know we're taking advantage of the discount because you see we paid it within 10 days, 210, okay? But this is the trick, not that it's a trick. We're not gonna take this 2% discount on $28,000, are we? Because we returned $3,600. So we're only gonna take the discount on what we owe them. Okay? So our accounts payable is going to be the $28,000 minus what we returned, the $3,600. So $24,400 is our balance. Okay? $24,400 times the 2% discount. $24,400 times 2% is $488, right? So we'll reduce our inventory by $488 because we don't have to pay. We're getting it cheaper. So we can reduce our inventory by that amount. And we're also showing we're paying cash, not of $24,400, but we get to subtract that $488. So do you see how it all balances out? Now I'm going to tell you, the thought is, where it can confuse people is you think, oh, I'm going to reduce my accounts payable by $23,912. No, you got to get rid of anything that you show out there because you don't owe him. We've got to, since we thought we were going to owe him $24,400, we want to zero that out, okay? And we're showing what we paid him, the $23,912, but the difference is really we're adjusting our inventory, okay? I'm just trying to let you know of a mistake that people can make. Is they think the accounts payable should just be the $23,912, but it shouldn't be. It should be the whole amount because we want to get it off our books. Okay? Next, on let's see. Assume that Chris Company paid the balance due to Frost Company on May 4th instead of April 15th. What would be the journal entry then, guys? We wouldn't have that discount, would we? So the accounts payable would be $24,400 and the cash would be $24,400. Does that make sense? Yes.
My question on inventory, if you're reducing that, where are you actually keeping track of the real physical inventory?
Good question. Think of it like this. If we're reducing it, inventory, okay, so let's just say this is our inventory T account, okay? Okay? What transactions did we have in here? We started with 28,000 or 28,800? 28. And then we returned 3,600?
Yep.
Then didn't we have to pay freight of so much? 700. Then we got a discount of how much?
488.
488. Debits minus our credits are how much, guys? 28,700. then 4,088. 88, so that's 2, 1, 6, 3. Am I right there? 23, 6, 12? Is that right? I feel like something's wrong. Is 28.7 minus 4,088, 2, 1, 6, yeah, 23,612. So think of it like this. All these debits and credits are happening all over the place, but really our inventory is going to be debited, credited, debited, credited. And just on this transaction, here's our inventory balance. Does that make sense? Everyone get that? And the truth is, guys, so many things can take place in here. You know, there can be adjustments to inventory, but for the most part, this allows you to see what initially started to be 28 had a couple transactions to come up with our new inventory balance, which is still an asset. It's not an expense yet. Okay? How you guys doing? You want a little break? Tell me.
Yeah.
How about let's take a 5-minute break, okay?